Hi, everyone. Welcome to today's PENTalk. We're going to walk you through some clarifications that have come about since the passage of the CARES Act. I'm Beth Parker with Pentegra. We're glad you joined us today. First, a couple of housekeeping items, to go over. If you have any questions during the presentation, please submit them through the question box, and we'll answer them at the end of the webinar. In the handout section of the control panel, you'll find a copy of today's presentation. You may download that now or at any point during the call. And as always, you'll receive an email from me tomorrow with a link to replay today's broadcast. Let's get started. We're joined today by our in-house expert on all things related to the CARES Act, Rich Rausser, Senior Vice President, Client Services. Rich joined in 1997 and has traveled the country visiting over 1,000 clients. One of his favorite things is to share his knowledge with others on the importance of retirement savings strategies. Rich, thanks for presenting today. Let's get started.
Good afternoon, everyone. Thanks for attending the webinar. Seems like we've been doing a lot of these webinars over the last couple of months. With passage of Secure Act back in late December and followed by the CARES Act at the end of March. We're now in a period of time where we're getting a flurry of guidance from not only the IRS, but the Department of Labor on various aspects of Secure Act as well as CARES Act. So today is a relatively quick update. Will be probably about 25 minutes or less, and just go through some of the very recent updates, literally, that have happened over the last couple of weeks. So we did get some CARES Act guidance, some additional guidance via 3 recent IRS notices. I think 2 of them were last week, and 1 of them might have been the week before. So the first notice was IRS Notice 2020-50, and this is dealing with clarification on CRDs and CRLs, right? So coronavirus-related distributions and corona-related loans, if you will. So a couple of important things have come out on that. I'll get to that in the next slide. Another notice, again last week, Notice 2020-51, gave us some clarification on RMDs, required minimums. 2020-52 gave us some additional clarity on safe harbor match, suspension, things of that nature. So today we'll also cover some other breaking news. I'll give you some comments on what may or may not be the next round of economic relief and stimulus, which is the HEROES Act, and we'll go from there. So let's dig in. Notice 2020-50. So again, this really is giving us, I think, some much needed relief, if you will. One of the things that was apparent when they wrote the CARES Act, and if you recall one of the earlier webinars, they said, well, who qualifies for a corona-related loan or distribution? And it was like, well, obviously, if you're the participant impacted by the virus, absolutely, you qualify. If anybody in your family, had the virus, right, your immediate family in your household, yeah, you qualify. And then there were like 5 or 6 other conditions. If your hours were cut back, if you were laid off, if you had issues about not being able to work due to childcare issues. So about a half a dozen of those items. But the most frequent question we got from participants is, well, I don't have the virus. I wasn't laid off or had my hours. None of that impacted me. My spouse or family members don't have the virus, but my spouse was laid off. Well, the way the law was originally written, you don't qualify. You as a participant don't qualify to take a loan or a distribution. So what this change did is basically gave the IRS, the IRS had the authority in the law to do this. So in terms of who qualifies for a CRD or a CRL, the loans or distributions, it now includes a member of the individual's household who shares the same principal residence. So if any of those 5 or 6 other items impacted that other household member, yes, you, the participant, even though you haven't been impacted directly, no virus and no layoffs, so on and so forth, yeah, you can still qualify to take a loan or a distribution from your employer's qualified plan. So that was a huge thing. I think that was relief that should have been built into the original law. So good news is now it's there. We've updated, our forms to account for this. So, we added that clarification on the forms. The other thing that the IRS clarified, and this is the position that we took from day one on it, by the way, but it's always nice when the IRS comes out with guidance that agrees with what you've been doing in practice. So self-certification, they absolutely clarified that a plan fiduciary does not need to confirm that the participant is a qualified individual. We had gotten questions early on in the process, where some folks at our plan sponsor companies were saying, "Hey, Rich, we don't," or "Hey, Pentegra, we don't, we think this person doesn't qualify." And some of my feedback was, well, I won't go into all the details, but there could be circumstances beyond your immediate knowledge that impacts that person. And the law to me was pretty clear on how it was written, but this really should put people at ease. Matter of fact, some of the commentaries from the IRS basically said, even though, you're signing off on a form maybe that participant submits, you're not certifying that they're qualified in no way, shape, or form. And the IRS even went as far as saying, well, it would be hard for any HR director or senior person at any company to really know all the facts and circumstances about the participant who needs the loan or the distribution. So self-certification, crystal clear in this notice, is all on the participant, right? It's all on them from a responsibility standpoint. So no worries there. And again, that was our original interpretation of how the law should be applied. So continuing, the notice also clarified some tax codes. Believe it or not, on the very first webinar that we did, literally 2 days after the law passed, the CARES Act passed, we got questions of, well, gee, Rich, what are the tax codes that are used for reporting purposes? It was uncertain, technically uncertain until now, but that was clarified. It's generally going to be, I'm not going to get super technical on this, but either it's a code 2 or a code 7. And I think a code 2 basically means it's a distribution with a known exception to the additional 10% tax, and 7 is an alternate code that sometimes would be used. I think by and large would be using a 2 code for this. But the other important thing that this notice clarified, I already put the second bullet up on the screen. Participants can claim a corona-related distribution that may be contrary to what the plan has done. So, and again, this has been our approach from day one of the law, that the CARES Act, that, I'm a participant in a plan, and even if I got a distribution prior to enactment of CARES Act, let's say I took a distribution from the plan a day before the law was enforced, I can actually, via my tax filing for this year, go back and claim that as a CRD, a corona-related distribution that qualifies, right, for a couple of special taxation benefits. Number one, if I'm under 59 and a half years of age, no additional 10% tax. Number two, I can spread taxation of that distribution over a 3-year period of time, 1/3 this year, 1/3 next year, and another 1/3 the year after. And the third element is I could choose between now and roughly 3 years after I took the distribution to repay that distribution to the qualified plan or to even an IRA account. So, it clarified, I think, what we already knew, which is good. The other thing the notice did is go through, and it was unbelievable how many examples they put in the notice. They probably put 8 or 10, I should count them, examples of how taxation or recouping taxes would work. So just to give you a little color on that, I took a distribution yesterday. I pay it back before the end of the year. Well, if no taxes were withheld, well, kind of no harm, no foul, so to speak, and I'd be okay. But then they give another example, like, well, I took the distribution, maybe I had some tax withholding done, and now I filed my tax return for 2020, and now a month later, after I file my 2020 tax return, I repay the distribution. Well, how do I recoup the money? Well, again, we've been saying from day one, you're probably going to just do an amended filing for 2020. So they go through ad nauseum 8 or maybe more examples of playing this all the way out to, bottom line, to me, it's really simple. You can have up to 3 years to pay tax on the money. To the extent that you repay any portion of that, you'll be able to recoup any taxes you may have paid via essentially an amended filing. So that's how that would work, and it's good that they confirmed it. So the other thing in this notice, and boy, they packed a lot into this notice, deferred loan repayments and amortizations, they gave us a safe harbor example of how that would work. And again, the way the law was originally written, the CARES Act was originally written, they said basically you can defer payments for up to a year on COVID loans from a qualified plan. We administered that a certain way. So we're looking at the example right now, the safe harbor example, to see, well, we may, I'm not sure yet, we may conform future COVID loans to this procedure or not. We may decide to either stick with what we've done or maybe there's a hybrid approach. So we're going to still look at that. The notice actually says crystal clear that even though this is a safe harbor approach, there are other reasonable ways to do it. So again, we're going to study that further. And by the way, there's no issue with the ones that we've done. I want to be crystal clear because the law basically said any reasonable interpretation of how it works is absolutely fine. And quite frankly, the government kind of signed the CARES Act to do a couple of things. Number one, primarily provide relief to participants who need relief via access to funds in their qualified plan. So I cannot think of any scenario where the IRS in a future period would do an audit and go to the participant and say, well, gee, you took this loan and it doesn't really conform to what we had in mind, and arguably are there taxes and penalties? They're not going to pursue that. That is not on the government's agenda with respect to this whole program. It was all about providing relief, and I want to say relatively immediate relief. Took them a little while to give us that other clarification on, if your spouse is impacted due to a layoff, so on and so forth, to come out with guidance. But I'm glad they did because that was much needed relief. And I mentioned this earlier, numerous tax situations were explained on the repayment of Corona relief. I wish they had done more examples on how to do the deferred loan amortization repayments, but it's interesting how they attacked that. The one aspect that I thought was relatively simple, they explained away. The one that was more complex, which is the loan repayments, only one relatively simple example. So the next notice, and again, these notices just kind of came back to back here in the last probably 10 days. Guidance on waiver of 2020 required minimum distributions. And again, this is something that in prior webinars, I kind of said, well, look, the CARES Act is pretty simple. It essentially means there's no such thing as an RMD for 2020. And that was the approach we took. That's the way the law was written. Pretty straightforward, pretty simple. We did try to accommodate participants who otherwise would have gotten an RMD this year, but for the fact that the law says they don't really exist for this year. So you may recall, our procedure was to write to everybody who hadn't received an RMD, who was scheduled to receive it for this year, and say, hey, we know you're expecting to get, or maybe expecting to get X dollars on such and such a date. The law says, we're not really going to pay that. However, if you want to voluntarily take that same money, you're welcome to do so. So we gave people the option. I don't have stats on how many people took us up on that. Well, I know at least one, but I'm sure there are others who kind of were expecting the RMD as part of a stream of payments for this year. So we tried to do this in what we thought was the most flexible manner possible. I might have pointed out in other presentations that some other providers kind of took a different approach, which mystified me at the time. I'm not going to name names, but I spoke to some very, very large providers who just kind of ignored the CARES Act. They kind of said, well, yeah, we're just going to continue to pay RMDs. And I guess if a participant says, please don't pay me, we won't. But their business model was to continue to pay them. And to me, that was contrary to how the law was written. Look, it was a different approach. It is what it is. But I think this guidance, by the way, kind of accounted for that. So this guidance on RMDs actually introduced a whole bunch of different ways of handling RMDs. Basically, in my mind, codifying the way that we did it, also allowing for the way other providers did it, where they kind of ignored the fact that there are no such thing as RMDs for this year, and they continue to pay them. So this kind of backs up probably administratively what they had been doing. So I'm not really going to get into much of this or any more of this right now. We kind of set the procedure. We think our procedure is reasonable, more than reasonable, and flexible, and really acts, I think, in the best interest of the plan participants. And we've already communicated out to clients as well as participants who were impacted. So we're not making any basic changes here. The last bullet I have here also codifies the fact that if you got an RMD before the CARES Act was signed into law, you can roll that money over. I said that, I'm sure, I know on one of the prior webinars that, the initial line of thinking is, well, if you got that RMD, and now it's not really deemed to be an RMD, under the strict reading of regular law, never mind CARES Act, you had 60 days to do a rollover. There was some relief relatively early on, so we knew participants would have at least until I think it was either mid-July or end of July to do those old rollovers. Now they said, look, if it was a pre-CARES Act distribution due to an RMD, you now have until the end of August to roll that over. So again, some additional relief. Good news for anybody who wasn't in tune with it, prior to this release. So yet the third notice sounds like a ton of material here in the last week or so, but 2020-52 safe harbor reductions and curtailments. IRS issued some guidance on this, right? Typically, when you do a safe harbor plan, you have potentially limited ability to take that away from people during the course of the plan year, right? Normally notice goes out at least 30 days prior to the beginning of the plan year. So, by roughly the end of November of last year, those notices would have said, hey, dear participant, we have a safe harbor plan and here's how it works. So this notice clarifies that you can do suspensions or reductions of certain safe harbor contributions, applies to 401k and 403b plans after a certain date in this year, right? Basically sanctions this throughout 2020. So basically makes it clear, if you're having any issues where you think you may need to curtail or cut back or cease on a safe harbor match, for example, you're able to do that. And it can be used, notwithstanding whether or not the employer is suffering certain economic losses. Or some safe harbor plans give what I call a maybe notice, or maybe we'll make the safe harbor, or maybe not. Maybe not is what we call it. So notwithstanding how those are written, you potentially have some relief that you otherwise wouldn't have had. So here's before I go too far with this, here's my recommendation. If you, or if you're the sponsor of the plan, if you think you need to or want to curtail safe harbor contributions to your plan, you need to talk to your Pentegra contact, either your relationship manager or maybe your plan consultant, to take a look specifically at your situation. All right, we want to take a look at the notice, we want to take a look at the plan document, and we want to take a look at how it ties into these safe harbors. So if you're having any issues thinking of curtailing, just get in touch with us and we'll help walk you through the process. So there's a couple of back and forths with this and how you do it, and we want to make sure you're doing it properly and correctly. Same thing goes for certain non-elective contributions. There are certain flexibilities that are in place now, and there's also a requirement now to do an amendment. But again, we can help you all with all of that if we're administering your plan. So all you need to do is reach out, let us know, and we can help you through the process. But again, all this does is give us all more flexibility in trying times. So we'll get to some, I call it breaking news. So shortly before last week, the Department of Labor issued an RFI on PEPs, pooled employer plans, and there's big talk in the industry on PEPs and how they work, and in theory they're going to be effective next year. But this was, by the way, PEPs were created out of the Secure Act passed in December. PEPs are a kind of a form of an open multiple employer plan. PEPs are called pooled employer plans, and very similar to multiple employer plans in that it's an aggregation of employers that are part of it, and they're designed or supposedly designed in a way to be cost effective and cost efficient. So DOL is seeking some guidance on that. We're participating in a group that is working with the DOL on how some of these rules are going to be working, and getting feedback from our group to direct to the DOL. So in addition, they've issued an RFI to the industry. I may have mentioned last time around electronic delivery of notices. Big thing out there, new procedures, new safe harbor, voluntary, by the way. We are looking at this to try to think about adopting it across the platform for anybody where we're providing fulfillment of notices to participants. As with anything, the rules behind this are rather extensive, and the hurdles you kind of have to jump through to go to true electronic delivery to satisfy the safe harbor. There's a lot of work involved, including mailing a piece of paper with certain critical information to each participant to give them the opportunity to essentially opt out or opt in or whatever they want to do. So we're looking closely at that. Long term, we think it'll be a big cost savings and a time and effort savings, and a more efficient, effective way to deliver all those notices that are required to go to staff, right, to your employees. So it's going to take a while to get there. A couple of other quick things. DOL issued an information letter on private equity and defined contribution plans. So if anybody has caught wind of that, kind of an interesting concept, right? Some of the popular press has said almost like, hey, good news, private equity investments can now be used in DC plans. Well, what I've been telling our clients is be careful here. This information letter was in response to a very, very specific set of questions, and the DOL actually went through quite a bit of dialogue on what you have to look out for and the fiduciary concerns. And what I mean by that is, private equity investments are not suitable investments for my view, for the typical 401k investor or participant. So there's a whole host of, I'll call it fiduciary issues that would have to be assessed before you can even possibly think of adding a private equity component to any of the investment funds in any of the 401k programs out there. They also DOL came out with some pretty harsh, I'll call it harsh, proposed rulemaking on environmental, socially conscious investment funds and investment procedures. And when I say pretty harsh, the proposed rulemaking, as I recall, was like 62 pages of a 10-point or an 8-point font on the rules. And they basically said, this is my view of what they said, in no way, shape, or form should you be using socially conscious decision-making in deciding on whether or not you should have that kind of a fund on the platform for the 401k. So bottom line is, real quick, we're just keeping an eye on it. The industry, by the way, on socially conscious funds has kind of produced a little bit of an uproar and so on and so forth. But, the DOL pointed out that in cases that they thought were more egregious, were situations where, in the investment policy statement, there were things like, well, we know that these funds may be higher expense, or we know these funds may perform at a lower rate than, peer comparisons in that asset class. They said, well, as long as we're disclosing it to you, the participant, just know what you're getting. Well, DOL has pretty much said, forget about it. You really can't and should not be doing that. And by the way, if you're going to put this kind of a fund on the platform, you better be able to justify why it's there and how it competes and how you screened it. Again, this is all my interpretation of how this rulemaking is going down, but in a word, it's pretty harsh. So we're looking at it. We're just keeping clients and advisors aware of the thinking that's going on in the industry. Another quick commentary, I might have mentioned this last time around, the House version of the HEROES Act. I don't think this will ever pass the Senate. This was another, round 4 of economic relief, another $4 almost $4 trillion spend, the Senate has really said, hey, we're not going to pass this thing in this form. There was something, though, passed, it was recently, July 8th, maybe. I might have the note here somewhere. Yeah, the Paycheck Protection Program, right? That's the loan program to quote unquote small businesses. There was a bunch of unused money there. I think it's about $130 billion. So that program has been extended through some period in August at this point to give small businesses an opportunity to potentially tap into additional Paycheck Protection Program loans, which ultimately could be tax-free if they use them in the right percentage to support payroll for their businesses. So I told you this would be a quick update. It is, in fact, a quick update. That's what we know today. And it seems like we're going to go through a flurry of breaking news on this kind of stuff over the next couple of months, because there's so much that the DOL and IRS have to clarify stepping into 2021. So with that said, Beth, I don't know if you want to do the wrap up and just give the final word on things.
Sure. I just want to remind everybody you can still download a copy of today's presentation that's available in the handout section. Also, tomorrow, you'll get an email with a link that you can replay the broadcast. If you have any questions, again, feel free to reply to tomorrow's email or, get in touch with your relationship manager or consultant, and we'd be glad to answer any questions. Thanks, Rich, for joining us today and updating us on all this information. Have a great afternoon, everyone.